follow through.
And a good way to know that is to look at the key sectors and the ETFs in the sectors and to kind of get the temperature of the markets and then to sort of get your strategy. And we wanted to break them down for you today. We start with the semis, SMH. It was up about, 0.4% last week, but in general, it was a pretty strong sector, which is impressive, especially as we're seeing more of a defensive rotation.
Yeah, there are like 3 different sectors right now that are trying to hold up, but my thesis in this market is if the market's going to go lower, just don't try and be in somewhere. I'd rather you be light or in cash. And if you take a quick look at these SMHs, they still are trying to hold this 21-day. If you are long them, if it breaks 36, you have to run for the hills.
And same thing with retail and healthcare, both up, 1-2% last week. How long can they really hold this well?
Well, they hold until they don't, and that's why you need to have your stops. Everyone thought, the Chinese internet group would never stop. You know what? They do stop, and there are sell signals. And if you look here at the RTH, it's still acting pretty well. It's way above the 21-day. I don't think it's going to be the only group that can continue to go against this market. So I would say sell some if you have some profits. If you don't want to get out of all of it, at least sell some, because when the tide goes out, it takes everything with it.
And healthcare.
Same thing.
Okay.
I don't think that these 3 are going to be able to stay up there, and if they start breaking below the 21-day, we'll see some more follow through to the downside.
We look at banks down almost 2% last week. I'm guessing you needed to stay clear.
Stay clear or stay short. At this point, I wouldn't short the open here in the banks. We talked last week that if we start breaking down, the banks were weak. Goldman under 151, that's where you short. And now it's a lot lower. At this point, I would cover some shorts into that, and then let's outline some support. But I think it's going to be much further down, so I'm going to avoid the banks. And I think you could cover shorts a little bit around here.
And the transports were down almost 1.5% last week. Now, this is a dicey sector because you can usually use this as a barometer for the health of the economy. Does that mean that the economy is kind of broken here, or is it more just maybe that we're a little slower? We're not as fast?
I think right now it's showing slower, not exactly broken yet, but we'll re-look at this down the road too to see if it's getting worse. But right now as well, if you take a quick look at the IYT, this used to look like the retailers, and now is starting to break this 21-day. I would say this is a sell signal. Next area to watch here is down at 95 and change, so I would get rid of some of these stocks in this area.
And we got to wrap it up real quick with the OIH down, 2.2% last week. But a lot of analysts and articles I've been reading have been saying that maybe there's now value in this sector because it's been so beaten down. Does the chart reflect any of that?
I love when they get beaten down, they become value. Not broken, but I understand that. And if, you sold correctly the OIH in some of these drills and you want to start piecing in a 3-tier approach, that's fine. But we showed the head and shoulders top in the OIHs. We showed how you could have gotten out a few times here, and now we're coming into some big support. So if you want to, dip your toe in, this is a spot, but I do think that it's going to get down to this 200-day at some point, so don't buy too much too early there.
But technically, still more damage. Okay, got it, Scott. Thanks so much. All right, we'll be right back with your stock buys for today.